Hello everyone, we're back with another portfolio update video. I thought like this title was appropriate both for these companies in question who have all been beaten up but questionably are recovering. A bit of a mixed picture honestly, but individually we'll walk through these. As well as my portfolio, which is now very comfortably back in the green, had another profitable week and feels like it's turned a corner, but I would say the market in general is still quite skittish at the moment and does feel like it's all over the place. Anyway, all that said, let's walk through it. All right, so first of all, in terms of changes over the last week, not too many, but a few things to go over. So we were able to deposit £800 last week. That's sort of a combination of a poker win, or blackjack win actually, as well as a late landing sort of utilities bill. So I was able to bring that forward a week, which was very nice, and put it to work immediately. Just the one dividend this week. I did technically receive a dividend from ASML really late on Friday, but didn't have time to reinvest it. So to save me messing around, I'll just report both of those next week. So the one I'm reporting this week is basically my emerging markets one. I'm actually quite bad at planning when the dividends from my ETFs and investment trusts are going to arrive. And I think that's because I didn't have these things at the start of the year when I was sort of doing the original planning. So whenever I get a dividend from one of those things, it feels like a bit of a surprise, honestly. So this is fine. This is a newish but 6 months investment that I've been gradually building up over time. And it's really just to give me some exposure to sort of, the global, but fairly big companies globally. Sort of one of them is like an Indian bank, and then you've got sort of a couple of big Chinese companies. So, some big players in there as well as TSM as their largest position. Next up is something which is I decided to sell Digital Realty Trust. It's had a little bit of a run up over the last few weeks. I actually did sell it at a very slight loss, but I've been in DLR a few times and I've had dividends over that time. So even though I sort of sold out at like a £30 loss on my active positions, overall my position with DLR has profited about £200. So we will be saying goodbye to DLR. And yeah, that was really my main thinking. I couldn't really see any reason for it to go much higher and decided to just sort of spread my risk. I still like being in REITs. I still think in the medium to long term they're a place to be. As soon as sort of the market is comfortable with interest rates not going up materially further, I think a lot of the REITs will start to fall back into people's views again. So actually my sort of medium term plan is to build quite a sizable position in my REIT ETF. And that's the approach I'm taking. So although I sold here, I basically put the money directly into that REIT ETF, which is TRET. And this is our VANEC Global Real Estate position. So I put this through as one, but my broker sold it as two, same with TLR. So yeah, just a straight swap basically. I still believe in REITs in the medium to long term, and decided that there wasn't any further catalyst, I guess, for DLR to run up further. So yeah, we say goodbye to DLR. Not much else to add on Treat, to be honest with you. And then for this one here, my global infrastructure, again, I added this at the same sort of time as I added my emerging markets, and that was because I realized I just didn't have them in my portfolio at the time. So these are my exposure. I have a much smaller position in the infrastructure. I spoke about it last week. I just find infrastructure a bit boring. I think it's quite difficult to get excited over infrastructure, but at the same time I totally get it's necessary, etc. So we're just building up this stake sort of £100 or £200 each time we deposit, and over time we'll build this into sort of a larger position, but it is never going to be a huge part of my portfolio. The next one, which is my mature healthcare and my consumer discretionary as well, which I didn't buy this week, but that's another sort of ETF where I just can't get too excited about it, and I don't really think I'm getting any kind of discount basically. So, but I did put I put 200 in the infrastructure and then 200 in the my mature healthcare, which again I think is fine. And then lastly here I put 400, so that accounts for the £800 deposit. But I put 400 in the emerging markets, and again that's mainly because it does trade on a modest but not insignificant discount against its NAV. And I do like the overall breakdown of the portfolio. It does have a pretty expensive management fee, so we'll keep an eye on that just to make sure it's performing strongly over the medium term. But right now it looks like a sort of 15% discount against NAV, which I'm a big fan of sort of buying funds at those kind of discounts when I don't believe there's a reason for them, basically. So that's everything I did this week. Next up, let's walk through the portfolio. All right, so just a very small change of approach here as we just focus on this top table now. I don't think we need to actually go into the individual weeks that we would typically start this section with, just because I've now tidied up the weeks. So, yeah, hopefully this makes sense. In terms of our week-on-week improvement, so our overall portfolio value with trading 212 rose 1238, although 800 of that is deposit, right? So our overall situation, at least on trading 212, was only up 438. However, there was a bit of a catch up with Google Docs. So if you actually look at our P&L, we sort of have 746 there being the difference. And again, we got a little bit of basically outperformance at the moment from Google Docs, which kind of explains the delta there. One of two things will happen on Monday, basically, when the markets open again. Either Google will catch up and it will go down, or my brokerage will catch up and it will go up. It's going to be one of those two things, and that's typically what I contend with on a Monday. But we'll see. Again, as long as they're relatively close, it doesn't matter too much. A few £100 on this portfolio value is fine. I mentioned about DLR here. That's the sort of change to realised P&L that I had. And then the dividends there just rounded up to the nearest figure for the dividend we received as well. So our portfolio now is at an all-time high officially. So we're not quite the 150 yet, which is super close, and we will get there very soon, I'm sure. But yeah, we can just about see on this graph here at an all-time high, so that feels very good. It has been a bit of a slog for the last, honestly, 2023, I would say, has been quite the slog. And you can kind of see here again, I've touched on this before, but I'm extremely volatile through 2023. We've now, I think, established ourselves solidly in second, created a bit of distance from the FTSE 350, which had a pretty bad end to the week. Managed to sort of just about stay profitable on Friday. But couldn't keep up with the S&P, which continues to sort of like actually build a little bit of gap at the moment. Honestly, I don't feel too bad about this. Like I would like to catch up on the S&P, but I have a few positions at the moment which are quite red and are sort of a bit of an anchor. In fairness, so does the S&P. But I do think that the S&P is sort of being carried by a handful of companies, and as soon as there's any sort of weakness or doubt there might be a pullback. But still, like I say, I'm broadly happy actually this week. It's funny how the mental state can change week on week. I've had periods where I'm just like, ugh, this feels rough. But this week it felt pretty fine, even though it was itself quite volatile day on day. So that's fine. Overall, we remain comfortably in profit. I would point out here that the blue line remains slightly within the purple, which means that we're only profitable because of our dividends. Broadly speaking, of our profit, about 80%. Just here. So overall P&L is like 6.6, but that's, you can kind of see here from the dividends, right, 7.6. So broadly speaking, our dividends are sort of making up more than 100% of our profit. Hopefully what we'll have soon is that the P&L will be greater than our dividends, so that then we revert back to the period where, like here, where this is the growth itself, the light blue here, and then the dividends are the pink. So the pink will always get bigger over time, just as dividend cumulative adds up. The growth is a bit more choppy, and you can kind of see basically when the blue line is above the green, that means that there's growth profit as well as dividend profit, and when it's below, like here and here and just about still here, you can kind of just about see it over here, that means that it's still underwater from that perspective. And likewise, profit over time here, it's been a pretty sharp reversal really in November. But we would still like to become profitable again for our UK shares. We still have the previous issue with the Russian miners that are sort of holding everything back. But again, mostly on balance, I feel pretty fine, especially when we start to look at some of this red here. So I guess, so there are a few companies I would like to talk about. The first one then being Adyen. So this is kind of an interesting one because I don't have a position in Adyen as a single holding. However, it features in like 3 of my ETFs. I also kind of want to talk about it because in my job, I've dealt with Adyen personally in my last employer, and I spoke with them on the phone like 2 weeks ago for sort of a sales opportunity. I'm very close to sort of PSPs, so payment service providers, and those kind of like payment aggregators at the moment. And although I don't sort of actively choose to have any holdings in sort of any payment companies, if I had to pick one, it would probably be Adyen. I think for me, like, there's a few things that have stood out as I've been sort of talking to payment providers over the last few weeks. The first one is like a lot of the companies that I've spoken to, and they're like European focused companies primarily. They view America as a bit of a sort of untapped, almost backward environment where, because of the size and power of some of the incumbents, actually they're a bit behind technologically. in terms of what exists in Europe, which I kind of think is interesting. And for things like fintech, London still quite comfortably crushes New York. It's not especially close. And there are other sort of like technical hotspots as well in terms of Europe. And I would count, the Netherlands as that as well, where Adyen is from. I think for me, the interesting one is like in relation to PayPal. And like to me at the moment as well, his share price does look very beaten up. But for me, it's been interesting because as we've been speaking to these payment providers, Adyen included, basically nobody processes PayPal out of the box. Is not, you basically have to pay extra for it as a company, and the main reason for that is because PayPal insists on its own agreements for things like indemnity claims, for processing fees are all much higher as well. So like they're basically they're sort of an outlier, I guess, where there is a certain convenience for doing them for sure. Like you can very easily find them, and in certain markets like Germany, for example, PayPal has incredible penetration. But I'm really skeptical about PayPal because it's just like every demonstration I've seen from sort of like payment aggregators doesn't include PayPal. Whereas like when I look at the likes of Adyen, the reason why I like Adyen so much is actually their data and their insights. They have like true data science. You can do very sophisticated sort of AVB testing. Sort of put in different payment scenarios, payment paths, change UIs very easily. Sort of again, well, like in my last employer, we were literally changing the shades of like reds and blues and pinks in our logos, and it turned out that like if you made it sort of more purple, it would actually materially change the percentage of successful payments. Just little things like that were very interesting, sort of psychologically nudging people in that direction. Like Adyen have that level of detail. I think as well for me, it's interesting with Adyen because I think a couple of years ago, even last year really, they were a bit of a victim of their own success where they kind of grew too fast, and then a lot of their really impressive stuff in years previous didn't seem as well supported, and they started to sort of be stretched, and we could feel it. Like in my last employer, it was really challenging. We actually went out to open tender but decided to stay with Adyen just because they were the best, but it was sort of like they damaged the relationship. However, I think like what you're seeing now is like a lot of hiring, a lot of investment, a lot of sort of laying the groundworks as they start to attack the US, and as they've kind of employed a lot more people. So I think like a lot of the way that Adyen's been beaten up has been way overdone and is kind of a lot of short-term thinking basically. Whereas I kind of think that PayPal, even though it's sort of quite beaten up, and probably is value to be found in PayPal, to be clear, I wouldn't want to get long term into PayPal. I think it's too risky. And to be honest, then just to round off payment providers in general, my main reason for not investing with them is because I think the industry itself is just incredibly ripe for disruption. Like the likes of Visa and MasterCard have just sat on incredible margins and incredible power. I don't think a lot of people realize how powerful payment companies actually are. They can absolutely shut down your business for sure. If you can't process payments, you don't have a business for very long, right? So it is incredible the kind of power they yield. They're complete gateways. They have incredibly high fees, especially at any kind of scale. Like I work in telecoms, so big scale, and they like having like 50, 60, 70p plus for processing an individual invoice, right? If you think about what the average revenue is on an invoice, it's actually quite significant, or at least not immaterial cost that sort of high volume providers have to add. It's also why you typically won't see Amex being accepted by sort of utilities companies. I think PayPal likewise you'll struggle to find in most utilities companies, certainly outside of Germany. Maybe there's a few other markets, but Germany is the one that comes to mind. Whereas, when I look at things like Google Pay, Apple Pay, these are things that are coming out of the box from the payment aggregators, no extra cost, and so they'll be adopted very easily and kind of form part of the sort of payment ecosystem. Likewise, even things like sort of, big data and data science and sort of insights, very valuable to us. Specifically with Adyen, we used to be able to see the individual BINs within the banks, and sort of right down to sort of like sort code level. Incredibly powerful what you can do with that kind of information. And again, see the success and failure rates against that, so X bank is underperforming. Why is that? Oh, it turns out that sort code group is linked to savings accounts, but that wasn't set up correctly with backs, right? That's a literal case of what we came across. Like basically you're in a situation where you're using the payment provider to go and fix an anomaly that exists elsewhere in the payment ecosystem. So yeah, I was very impressed with the response to Adyen's Investor Day, which seemed to sort of underpin a significant rise again. Adyen has historically looked very expensive, especially when it was kind of going through its growing pains. However, I do think that the pullback is massively overdone. And to be honest, if I was still buying individual shares, I would have definitely been buying, and it's a bit of a sad one I didn't have a chance to buy. However, I would also, because of my position on payment providers and not knowing who's going to win long term, I probably would just take my sort of 20% profit that I would have made and be quite happy with it. But like I say, I can absolutely understand why people would want to hold Adyen. And, you know, if people are either bag holding or have recently got in, honestly, I think there are worse places to put your money in the payment sphere. Certainly, that's kind of what I'm seeing from you know, somebody involved in the industry, and etc. So I thought that was very interesting. In terms of Disney, so I quite liked Disney's numbers. They were reassuring. Like, it wasn't a smash, and I think the response from the market was probably about right, sort of plus 5-6% when the results were announced. For me, there were two big things that I think are worth calling out. The first one is, like, when you look at the numbers, the revenue was actually pretty much a match. It was sort of materially in line with expectations. But the EPS was quite far ahead. And when you actually looked into the details, there were two main reasons for that. The first one was just a much better grip on costs, which I think have been a problem, especially for sort of the production side of Disney. You know, I think the sort of when you're sort of spending $300 million to produce a film, you're probably spending a similar amount to sort of market it and everything else. Actually, you need a huge return on your investment in films, and it's just such a high risk venture that unless you've got a very bankable product, it's not worth that risk. Basically, like, that's something where I think, you know, the accountants and the creators need to sort of come together, and maybe there's been a bit more discipline starting to be restored in that. So I think that's good. The other thing, which is kind of buried, but I think it was Joseph Carlson, so I should credit him in raising it. But there has been a big improvement in the split with Disney Plus, Hulu, and Hotstar specifically. And I think it's promising because what I expect to see soon is that there's kind of going to be a kind of ARPU improvement within Disney streaming service. Like, not only did they add a few more million customers and everything else, you know, beat expectations there as well, which is great. But I suspect that, especially once you get past the introductory periods, you'll start to see a significant improvement in the average revenue per user on Disney streaming. So for me, that should be good fun, and really support that for sure. I also wanted to talk about medical properties. So definitely in terms of not a return to form, they really, the main catalyst here was an analyst downgrade from somebody who was already quite bearish. I mean, again, I've spoken about medical properties before, but I feel like it's just worth addressing when the market was quite friendly for parts of the week. And, you know, the new-ish arguments are that some of the restructuring is going to be blocked or is sort of more complex than was originally planned, and etc. But I'm like looking ahead of the sort of earnings for next year, and they're basically trading on a 5. So there is literally just a 5 forward PE, or the equivalent of. And so that to me is just quite surprising. And again, I look at their debt maturity profile, which again, I do understand that high interest is unhelpful for REITs and all the rest of it. I also understand that, you know, the hospital sector is not the easiest sector to operate in for MPW, or indeed anyone else in that sphere. But I don't see the pain. And I have taken haircuts before, and I have sort of thought to myself, maybe I should just sell out, but I just don't want to. So even though I'm down like 70% at the moment, like my average price is sort of like $15, so this is quite painful. And I've got adverse FX as well, so that's quite nasty. So it doesn't look at this time that MPW is returning to form. My hope, I guess, rather than expectation, is that the earnings will improve next year in line with expectations, and that will sort of like prove a catalyst to sort of squeeze out any of the bears. But definitely at the moment, the Bears sort of feel like they've got stuck into this and haven't let it go. I try not. That sounds a bit like overly emotional, I guess, and overly sort of like it's being driven by one or two key people, but maybe it is. And MPW did try and sort of fight back when it was sort of $8 to $10. You know, launched lawsuits, put out decks, etc., which are available on their website, sort of explaining that their customers are well covered on the whole once you exclude Prospect and Stewart, the two big boys. But there's definitely some pain there. But I look at the share price and the sort of earnings. The dividend was confirmed for January quite recently as well, so there's no sort of doubt for the next quarter in terms of that dividend. So again, it was slashed previously, but now the share price has again fallen so much that it's sort of back to where it was before in terms of like a 15% yield. So no idea what's going to happen with that, but we will see. But for me, I remain in there. And then the last one I wanted to speak about was Redrow. So this is kind of an interesting one because it's my house builder of choice. I've been in a number of house builders and decided that I still liked the look of house building in the UK in general, which again might seem risky. And again, house builders are definitely impacted by high interest rates, sort of construction costs have been significant. There are all kinds of planning difficulties in the UK as well that slow this stuff down. But to me, I look at the UK housing situation and basically it's economics 101 for me, and that business case remains the same, which is simply put, there is not enough supply to meet demand. So whenever that happens, prices go up, right? Long term, that's economics 101. And so yeah, so I think that's why I want to be in house builders. For Redrow specifically, I decided for a couple of reasons. First of all, Redrow don't have any material exposure to the cladding issues that UK viewers will certainly be aware of. So there shouldn't be any sort of cost to fix that unless it's an industry-wide cost. So less exposure from that perspective. Also, as well, they don't have a ton of exposure to sort of new builds, first time housing, to flats, etc. They specialize in building sort of what I would class as forever homes. You know, your sort of £500,000 plus homes. And I think like the market is a little bit more insulated, or my thesis would be that the market for those kind of homes was a bit more insulated. However, Redrow put out a earnings update that was initially really poorly received, which was basically reaffirmed guidance, however, would be on the lower end of guidance. But it's a fairly narrow range, so it wasn't like, you know, a particularly big difference either way. But I think the more concerning thing was that cancellation. So, you know, home buyers put down a deposit but then decide to cancel before sort of moving forward. And although there is some revenue gain for that, the main thing is Redrow sort of, you know, they've seen a slight reduction in their average house selling price. I'm not too surprised by that. It's down like 2%. So I'm actually kind of okay with that number. But I do think the 25% increase in cancellation rates is a bit concerning. And that does sort of challenge my reason for Redrow specifically, which is that the buyers would be a bit more insulated. So the market did recover after the sort of 6% fall, I think it was at its worst, and I still don't view this as particularly expensive. Again, a lot of the sort of sentiment around UK house builders is so already built in that even bad news is kind of accepted quite quickly. It has to be really bad, and any kind of good news is sort of really jumped on as like, okay, maybe they're outperforming. So I definitely wasn't completely happy with the Redrow trading update. I thought the lower guidance was fine because the ranges are so narrow, and even the 2% reduction in average selling price, I wasn't too disappointed with that, to be honest. It's still kind of a very chunky number with good margins, good land banks, good construction pipeline, etc. So I'm not too worried about any of that stuff. But yeah, the cancellation fees, we don't want that kind of cancellation rate, sorry. And yeah, it does sort of challenge one of my key reasons for Redrow specifically, because the other one I thought about a lot was Vistry, who have recovered a little bit better, I would say, than Redrow, so I sort of maybe backed the wrong horse. But we'll see how all of this shakes out anyway. Vistry were also a bit of sort of a turnaround play, and I wasn't sure how they were going to do. Redrow, to a lesser degree, a turnaround play. They've kind of had a strategic pivot away from sort of London and the southeast, more into sort of the Midlands and sort of north of London and west of London commuter belts. And part of the reason for that, they were saying, is that it's just slightly cheaper. The construction costs and the land bank is slightly easier and quicker to turn around, get planning permission, etc. So I also thought that would be helpful as well. But so far, it's again, I don't think it was a disaster of an update or anything like that, and I think it probably being flat on the week is kind of okay when you consider that it's hardly an expensive share already. But again, I think it's just worth addressing Redrow specifically in the wider housing market outside of that. Other than that, Genius Sports are reporting on Monday. I had actually thought it was going to be this week, but we will see. There wasn't very much movement on this. They did have a bit of movement the week before, basically with DraftKings, who put out some decent numbers for sure. I'm very curious to see Genius's results, and for 2,000 shares, actually any kind of material movement in their share price will definitely have an impact at these kind of levels. Anyone else here to pick on? Let me just scroll down very quickly. We've already talked about Disney. Kanos also had a solid week. By the way, I would count Kanos. Everything I said about Adyen, I would kind of class the same as Kanos, right? They've kind of gone through a very similar last year where they've put in place a lot of costs. And I mean, everything ranging from like a new campus that they've been built at one of the universities in Northern Ireland. They've sort of enhanced their relationship with Workday so they can start going for larger and American clients as well. And they've kind of gone on a bit of a hiring spree as a result of that. So some of their margins are under pressure. But again, this is a really good foundation, forward-looking business. And I think this is quite, again, I don't want to use the word cheap. Like, it trades on a chunky multiple because it's a good company with lots of promise. Already very profitable despite being quite small. However, I do think sort of compared to itself, it doesn't look expensive at the moment at all. And, you know, if I was able to buy individual shares, I would absolutely be buying more Kanos. I think it's a good bet in the long term. Anyone else here? Elixir here is kind of one of my small caps really, so but it's quite an illiquid stock, so it can have big movements, but I don't really have too much to add about that. You can definitely see this week, it's a fairly mixed week, not too many reds or greens, sort of the movements were just on the modest size, but to be fair, I mean, my top 5 here are all having profitable weeks. This ETF, it was a bit of a shame when I was adding money, I was tempted to put some money on this, I wanted it under like 260. But I just couldn't get the right buy price, so otherwise I would have added to Allianz. I guess in fairness, the other concern I did have and why I wanted a bit more of a discount is because Nvidia has become the largest share in it, and I'm not confident with that long term. You can see here, by the way, Google Docs live document just having a bit of a meltdown, but I think I've said everything I want to say for this table. So without further ado, we're going to move on to our non-financial performance over the last week. All right, so in terms of our non-financial targets, although we do start with contribution to wealth, this was actually pretty good. 1.8k addition week on week. So £800 of that was added to the ISAs, £200 was added to my junior ISA, and the rest is basically my wife's pension. So the pension is through the work, so we don't have to do anything extra for that. It's taken out already and then catches up sort of the next month. The junior ISA I spoke about before, but basically we didn't do our regular £100 last month, so we're doing 200 this month. And then the 800 I've just touched on as well in this video. But again, that's possible because, you know, just a few bits coming in a bit earlier or costs not arriving quite when expected. So actually 1.8k here is pretty good for, you know, this is normally our quietest time of the month because it's the furthest away from either my payday or my wife's payday. So that feels good. Also as well, total wealth, sorry, of 1.8k, primarily added from market performance, honestly. Profitable week for me, and the stock market also impacts our private pensions as well, so that's good. And the poker win here specifically of £270 makes some contribution to that. I think it's important to clarify that, you know, like the contribution to wealth, a lot of these things were already sort of in our total wealth. So if I look at like the junior ISA, for example, of £200, then that figure is only moving from my bank account to the junior ISA, right? But actually the total wealth doesn't make any changes as a result of that. So it's kind of like, okay, it's still there. It's just not something that we're investing. So that's like the reason for the top line there is sort of the contribution into investments. The same thing would happen with things like premium bonds or indeed the ISAs when they happen. The total wealth does actually include the cash in the bank, and even actually cash that I have for things like poker and blackjack, right? I sometimes do float quite a lot of cash. So that's really the difference. The total wealth will include sort of cash and other assets that aren't yet invested. So that just in case you're wondering, like this is a separate 1.8k, it just happens to be exactly the same number. And again, here, this is mostly market performance other than a little bit of extra cash that we basically bought in from the blackjack win. So that's good. In terms of work, honestly, there's so much ongoing at the moment. I have a few people in my team doing various things. Sadly, actually, my main process and project person is going to be taking a few weeks off for paternity leave. I mean, it's obviously great news for him, but doesn't mean we'll have to manage without him for December. I do imagine that there'll be a change freeze at some time in December, so hopefully that won't be too disruptive. And again, we'll just have to make do, right? It's one of those things, so that's fine. Bill cycle allocation here, this is sort of when you make plans for sort of how customers will be in the systems, right? We sort of bill customers on different days. So there's some sort of work ongoing at the moment to spread that out and make sure that we have a relatively consistent flow. That really matters for things like how long processes take, what the customer services support is, right? Volumes, etc., can make a big difference at scale. So important that we manage that through. Then we've got like some automation starting to arrive as we gear up for the really big migrations, not just the proof of concepts that we've done so far. And then also actually somebody in my team delivered a really nice improvement for sort of using some scripts to improve a manual workaround that we're having to deal with at the moment. So that was a really nice win. I'll sort of have to give him a sort of shout out at some point. Outside of that and the sort of group change, so outside of my team, developments remain on track. I have a monthly call with the CIO, so basically our chief techie, and I was happy with that update as well. So that was quite a big one because there's a number of important things that have to be delivered before we start doing the really big migrations. So that was a pretty important meeting, but it went really well, so that felt really good. No update on revenue assurance, propensity to call reduction. So actually there was a cool session on Monday. I really enjoyed it because we're starting to sort of get our house in order and really sort of share insights, and maybe not insights just yet, maybe share data is the better way of talking about it. My area is also trending down, so that felt pretty good, as in positively. Fewer people contacting, which means that they're being self-served accurately first time. But still, we've now been given the dashboard and basically been told to go away and look at it and see if there's any sort of call outs and insight that we can share with the group. So me and somebody else are working on it on Friday, and we're going to be presenting, the bit from my area on Monday, alongside everyone else in the different teams. So actually, I'm really looking forward to that sort of follow up as we start to sort of pull out what the data is telling us and make sure that we're, developing in the right areas. Next up, team organisation. So I had a chat with somebody, one of my more junior members of staff, and he basically, we wanted to put him on like a development track, so that's awesome. So I've suggested to his manager, who reports into me, that we will update his job description and job title, basically moving from a credit controller to a billing analyst, which is more reflective of what he's doing anyway. It does come with a bit more money as well, and I think it's a good next step in his career. So actually I had a very good half an hour conversation with him on Thursday, and sort of pinged a few emails off to sort of kickstart the next process, but hopefully that should now take care of itself. But those kind of things are actually really rewarding. Like HR can be really rewarding and really infuriating. So it's nice when it's the former, like these kind of things are. And then the end-to-end data reporting. Again, we continue to focus mainly on the way that debt is reported and forecasted in the business. So I had a chat with sort of core finance, including my peer over there. And that seemed to go well. We sort of clarified a few things and agreed some next steps, so that should be good as well. I really like my the FD in our company. He sort of joined at a similar time to me, and I think he's great, so very easy to work with somebody like that. Now we start to go off the rails a little bit, to be honest with you. I had no physical workout this week at all. Honestly, I had a poorly tummy for half of it, had a headache for the other half of it. I was also just tired, sort of trying to support my wife as much as I can, who's super busy at work at the moment. That all fed into the fact that not only did I not do any exercise at all, but I also went up 2 kilograms in 1 week. So I was quite surprised by that, honestly. But I have been doing a lot of snackage, not been sleeping as well, etc. So that's a bit disappointing, honestly. But it is what it is. I just couldn't do it. I had no willpower. I think this week my sort of resistance levels and motivation levels were really sort of limited, and therefore were focused on what felt like more important things. Certainly in the short term, I appreciate in the long term. I should, that's why they're on this list. But not a great week for the sort of fitness and well-being side. So I mentioned about the fact, my wife's really busy at the moment, and because she's got the sort of promise of a very big promotion. Not the promise, that's the wrong word, the hope, but again, she's had chats with her manager, and I think she sort of should get some promotion at Christmas. We're sort of making sure that, she's able to focus, and, like actually tomorrow I'm going to take my daughter out for the day, and we're eyeing up the aquarium, seems to be the ask, so, but yeah, she continues to do well in school, so that's really good, so it's a bit of a treat for her, and she asked for it actually. She was like, I want to go to the London aquarium though, not the one in Poland. Apparently the London one is sort of a bit more novel now. So that should be fun. So I'm looking forward to that. I wasn't able to catch up with my aunties when they visited on Thursday. A bit disappointed, honestly. So just because one of them especially I don't get to see too often, and she's a really nice lady. But it wasn't to be, so that's okay. Hopefully, paths will cross sometime in the future. I've actually caught up with a number of friends this week, all remotely, nothing in person. But again, sort of that was nice, and agreed sort of a few favors in terms of sort of raiding my LinkedIn connections list or reviewing a CV, that kind of stuff. So things that I do actually enjoy. That are in my sort of capability to do. So I'm going to try and squeeze that out before I leave for the aquarium tomorrow, and one of those to do tonight. Sorry, it's Friday evening, in case anyone's wondering. And also in terms of professional, a recruiter is going to take me out for coffee on the 23rd. I don't expect it to be anything immediate. We don't have any sort of, I have no plans to leave my current employer. There's like lots of work still to be done. And it's mainly just to sort of network. And to be fair, I mean, a few months ago, she sent me through a job description that in another world could have been interesting. Certainly it was good money. So these kind of like niche recruiters, I like to have periodic chats with, just because again sometimes things open up, and it's often the sort of relationships that help get you into doors and stuff. So that should be nice. In terms of YouTube videos, so this is one of my successes this week. I think where I didn't have any physical energy, I had a little bit of like mental energy to do some videos, so that was quite nice. And I mean the last one I did, especially where I was like looking at my October costs. Really interesting. I sort of shared that with my wife as well, who was also interested. So that was fun. But yeah, 3 videos in a week is actually my kind of long-term target. It's my aspiration, but it's a kind of very woolly aspiration with everything else going on at the moment. So it's nice to be able to do 3 videos in the week. That's cool. Unfortunately, no progress on my Polish tour. I don't want to pretend like I've made any sign of progress here. Similar on this one as well, so no update there. And then regular reading, likewise, no update here. I did read a few newspapers in London. They're all free, so that's nice. I did also buy another book. I sort of saw a Reddit story just playing in my ears from YouTube, but it was a Reddit story. And it was just about these kind of crazy things in history that sound almost unbelievable. And it was just about this spy in World War II who was sort of like one of the most successful spies in history by all accounts. So I found a story so incredible that I sort of bought his book, and we'll be reading that. I've still got my big book to read through on the Roman Empire, but it's so big that I just it's not an easy thing for me to carry around with me. Whereas this one is a lot more, I can put it in my laptop bag, and it's absolutely carry aroundable. So I think what I'll do is I'll basically have the Roman Empire book for home reading, and then this book for sort of out and about reading. So that should be good. So. Honestly, a pretty mixed week. Like I would say, like work's gone solid, wealth has gone solid, and relationships also feel pretty good. Development's mixed, and yeah, fitness and well-being. So maybe overall it's kind of okay, actually, just kind of summarising that. But it could definitely be better, and hopefully we'll make some improvements in this one shortly. I haven't got anything else to add outside of that. Any questions, normal stuff, all down below. But thank you very much for watching, everyone. I've been the Boss Hog, and good luck with everything. Bye for now.